Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special report on interest rates brought to you in association with ASB. Today we want to have a look at what's happening with longer term interest rates. For years now, New Zealanders have gotten used to their fixed mortgage rates, let's say 1, 2, 3, even 5-year mortgage rates, being lower than the variable rates. But I think it's time now to start saying that long-term rates, particularly 3, 4 and 5-year rates, have hit the bottom. They have troughed out at around about 6% and are unlikely to fall that much further. In fact, they're likely to start rising again. Meanwhile, the variable rate, which normally is higher than the fixed rate, has actually fallen quite substantially in the last couple of weeks and is continuing to fall. We are now going to be in the unusual position in probably 3 or 4 weeks' time, maybe a month's time, where for many of the banks, their variable rate is at or below the levels being offered for their fixed rates. Now we're starting to see some big moves here. Kiwibank today has cut its floating rate under 6% for the first time in New Zealand since August 1965, so 44 years. The ASB too has increased its 3, 4 and 5-year rates to above 6%. So we've got to ask the question, why are these longer term rates becoming more expensive? Surely the Reserve Bank is continuing to cut the official cash rate. Isn't that what really matters? Well, actually, no. For these longer term rates, it depends on what's happening in the international markets and what's happening in our local wholesale markets. And it's true that the wholesale rates, what they call the swaps rate, is continuing to fall. But frankly, that's not the rate that banks are having to pay when they fund the mortgage they're giving to people in New Zealand. They have to pay that swaps rate plus a margin, and when they're borrowing overseas, there's another margin on top of that. So we saw today with BNZ issuing the first of the government guaranteed wholesale bonds in New Zealand that the margin they were paying was 80 basis points above the local interest rate. And we expect in the next couple of weeks most of the banks will begin issuing these wholesale guaranteed bonds in offshore markets. And there, the margin will be quite a bit higher. Some people are talking about 250 basis points. So what does this all mean? This means that the banks are finding their funding costs, so how much it costs them, to get the money for the mortgages that we're taking out, particularly for those 2, 3, 4 and 5-year rates, are going to be at a baseline of around about 5.5 to 6%. Now that's before they charge their own profit margins. So all of this means we don't think that longer term interest rates are going to fall much below 6%, even though we're going to see the official cash rate drop towards 2%. What this means is that in New Zealand for the first time in an awful long time, we're going to see what they call a positive yield curve, where it's actually cheaper to go for the variable rate than it is to go for the longer term fixed rate. And we're going to see a lot of people switch from fixed rate mortgages into floating rate mortgages. One caveat though, be very careful before paying big break fees to go to a variable rate mortgage, particularly if you're thinking of capitalising that big break fee. You will pay for it a lot in the long run as that break fee accumulates its own interest. So be thinking about what the long-term real cost of capitalising that break fee is. I'm Bernard Hickey. That was a special report on interest rates brought to you in association with ASB.